This is a smartphone. A typical smartphone contains around 75 out of the 83 non-radioactive elements of the periodic table. 6 of them are part of the 12 elements considered to be at risk of depletion in the next century. This is what scarcity means. Elements that we are used to take for granted will no longer be available in large quantities and will therefore need to be allocated very carefully. It is the root and definition of economics itself, which is defined as the science of allocating scarce resources. If we look at how humanity behaved over the past 50 years, we haven't really taken into account the environmental limits and the scarcity of the resources that we have been using. We've always taken them for granted, like they were infinite. Ever since 1970, we have been using every year more natural resources than our planet can regenerate in the same amount of time. This kind of exploitation is not sustainable in the long term. We need to rethink our economic model towards sustainable development. Sustainable development means ensuring a level of economic growth that allows meeting the needs of a growing number of people, but doing it within the environmental limits of our planetary stability.
Here is the challenge. We need to make sure humanity can sustain economic progress to provide food, healthcare, energy, education and mobility to everyone, while keeping an eye on environmental boundaries that will become tighter and tighter. In other words, we must be sustainable. The words sustainable or green are often misused in finance. Let's take investing as a clear example of this. It's quite hard to classify your investment as sustainable when your fund or portfolio is invested in very carbon-intensive companies. We believe true sustainable investing works differently, focusing on global companies that have a wider approach to sustainability and green transition. These companies belong to many different sectors: industrials, materials, IT, utilities, healthcare and consumer staples, and they must be selected carefully.
Well, we believe in an approach that places a deep analysis of a company's sustainability credentials before the fundamental financial analysis. But what does this mean in practice, and how do we define deep? One might be inclined to think that looking at ESG scores of companies may be enough to tell how good and how sustainable a company is. The reality is that this is not enough, and relying only on high-level ESG scores may be misleading. Let's look at an example. Company A is a leader in the energy sector with a ESG score of 75 out of 100. Company B is a major player in healthcare and life sciences. Its ESG score is much lower at 25. If we stopped at the ESG score, we would assume that Company A is a much better and more sustainable company than Company B. As the saying goes, however, the devil is in the details. If we move beyond the headline and look closer at other parameters, like the percentage of revenues derived from fossil fuels, for example, or controversies in which the companies might be involved, then we see that Company B turns out to be a much better fit for an investor targeting sustainable investment.
Our analysis reduces the number of companies that we are comfortable in defining as sustainable business. The idea behind a good investable universe is therefore the identification of sectors where scarcity is a key issue, plus the imbalance between supply and demand, coupled with a deep understanding of companies' financials and non-financial history. The framework to select companies that will successfully overcome this historic challenge while respecting planetary boundaries. Great businesses which can generate long-term returns for stakeholders and investors.